Hi, my name is Corey Ward, and today we're going to do some financial analysis. We're basically going to take two sectors, pull out 5 companies from each sector. We're going to whittle that down to pick one company per each sector, and then take those 2 companies and pit those against each other to see which one we'd ultimately recommend. The way we're going to measure them on leverage, how much debt do they have versus their ability to pay, asset efficiency, how quickly and profitably are they turning over their assets, profitability measures, market value, price earnings, market to book, and economic value added. The first sector I've picked is oil and gas, and we have Exxon, Chevron, Murphy's, Marathon Oil, and Hess Oil Corp. And you can see over here I have a market capitalization chart. Exxon clearly the biggest, followed by Chevron, Marathon and Hess about the same, and Murphy's there on last. Exxon Corp's founded in 1870, and they just about do it all, guys. They're pretty much all over the world. Chevron is really about the same, founded in 1879, based out of California, and they're pretty much consistent with what Exxon does. The smaller companies, they're doing a little bit less. Marathon was, Murphy's was founded in 1850. They are worldwide, not quite as extensive as the larger guys. 1887, also based out of Houston, Texas. These guys they're worldwide as well, offering a little bit less products than the bigger ones, but pretty consistent with the smaller ones. And the same thing here for Hess, founded in 1920. They're worldwide as well, but they're pretty much consistent with Murphy's and Marathon. The first measurement we're going to look at here is the equity multiplier. This is the debt constraint, so we want the lower numbers here, and we can see Exxon and Murphy's right there at the top, followed by Hess and Marathon and Chevron at the bottom. So for this one, we're going to say Chevron's doing the best. The rest of these guys are kind of high. But if you consider their ability to pay, the debt capacity, the time interest earned, you can see the rest of these guys are down at the bottom, and Exxon has a quite a larger ability to pay than these guys do as far as that concerned. So the higher debt on that last one is really not a big deal. Once again, we have Exxon here at the top using asset efficiency. This is total asset turnover. So and then underneath that, Chevron, and then we have Murphy's, Hess, and Marathon here. And we see that a lot in here. We see the bottom, we see a grouping, and then we see some above and some below, and it makes it really easy to see which one are actually doing better and which ones are doing a little bit worse. But for the asset efficiency, total asset turnover, Exxon's clearly the best. The tax burden, now there's not much they can do about this, but Hess up here at the top, followed by Murphy's, Chevron and Exxon right here about the middle, and you would expect that from companies that are a little bit larger, and Marathon here at the bottom. Interest burden, once again we have Hess at the top and climbing, followed by Exxon, Chevron, and Marathon here, and Murphy's at the bottom. Operation burden here, now this is the first thing our managers control and we can actually look at objectively. Here we have Marathon at the top, followed by Murphy's, and we have the rest of these guys in a grouping, and they're a little bit larger companies, so I'm not too worried about it. Profit margin, remember that's those 3 burdens we just looked at all put into one, and we know obviously we're going to have Hess here climbing, followed by Murphy's, and the rest of these 3 in a grouping with Marathon headed up and Chevron and Exxon both headed down and at the bottom. Return on assets, once again, Hess shooting up, we have Exxon going down, Chevron going down, Marathon here at the bottom with Murphy's. And remember, this is those 3 burdens that we were looking at plus the total asset turnover. Return on equity is all those 4 things plus the profit margin, plus the equity multiplier. And we have Hess going up, followed here by Exxon but falling, as well as Chevron, Murphy's headed up but low, and Marathon there at the bottom. Price earning, these are our market value measures, and we can see Marathon's right here at the top. Murphy's and Exxon right about the same and climbing. Chevron right below them and climbing, and Hess pretty much playing out here, maybe on the descent a little bit. Market to book, and we can see up here that that Exxon's by a large margin here at the top, followed by Chevron, and the rest of these guys are pretty much grouped together. That is Murphy's, Marathon, and then Hess there following it. Economic value added. Now it's really hard to tell from this chart. Clearly you have Exxon above, but these guys just kind of look like a smudge, and that's for a good reason, because the latest data pretty much has Exxon up here at 5,160, and the rest of these guys, every single one of them are negative. Its closest competitor is Murphy's over here with negative 26. So to recap the analysis, leverage, I'm giving it to Exxon. They were high, but they had the ability to pay it, so I'm not worried about. Asset efficiency, Exxon was high there. Profitability, Hess was high in all the profitability measures, but I'm not too concerned with that, as Exxon wasn't very far behind in most of those categories. Market value measures, we had MRO in the lead, followed by Exxon. Exxon dominated the market to book, that was pretty clear, and we know Exxon dominated the EVA measures. So From this sector, we're going to move on Exxon just for those reasons I've just listed. Now let's move on to the pharmaceutical sector. Pharmaceutical sector, we have Pfizer, Bristol Myers Squibb, Johnson & Johnson, Eli Lilly, Merck & Co. And you can see the market capitalization broken here. Johnson & Johnson clearly taking it, followed closely by Pfizer, Merck right there, Eli Lilly, and Bristol Myers. These are a little information about the companies. Pfizer was founded in 1849. You've all heard of them: Lipitor, Celebrex, Viagra. Bristol Myers Squibb, 1887 over here, and they do a little bit different molecule productions and virology, pretty much all in the pharmaceutical industry, but different kind of pharmaceuticals. These guys, Eli Lilly, founded in 1876, they do regular human pharmaceuticals as well as they just took over a company that does animal pharmaceuticals. Merck & Co., 1891, once again, therapeutic and preventive agents. Johnson & Johnson. Johnson & Johnson does pharmaceuticals, but they also do a lot of the products we get over the counter: baby oils, Tylenols, a lot of the things you see on the Walmart shelves. Measure of leverage here, we can see Bristol Myers at the top, followed by Pfizer, Eli Lilly, Merck, and then Johnson & Johnson here at the bottom. So remember, we want this to be lower, so Johnson & Johnson's taking this one pretty well, and Bristol Myers might be in a little trouble there. We have Johnson & Johnson at the top, so once again, not only do they have the lowest debt, they have the greatest ability to pay. Bristol Myers was at the worst condition for the last one, and it's here down here, headed down. Eli Lilly's in second, and we have these two guys, Merck and Pfizer, headed at the bottom. Asset efficiency, we want this one to be high. We have Eli Lilly at the top, Johnson & Johnson in the second, both of them kind of planing out. Bristol Myers is in third and following. Merck had a real problem here, falling, and Pfizer kind of leveled out there. Tax burden, we have Pfizer here at the top, and the rest of these guys are grouped together. We wouldn't be very selective among that. Interest burden, all of them grouped together. Once again, not a big deal. I'm not going to try to distinguish out of that. Operation burden, here we have Pfizer at the top. It is falling, but Johnson & Johnson pretty much straight, but a little bit inclining. Eli behind that, and Bristol Myers and Merck here both falling. Profit margin, remember that's those three things added together. We have Pfizer way up here, and we have the rest of these guys pretty much grouped together with Merck on the decline. Return on assets, Eli Lilly's up here, followed by Pfizer, right behind Johnson & Johnson. Bristol Myers kind of planing out, and Merck is down there and falling. Return on equity, pretty much grouped together with the exception of Merck here, is a little bit at the bottom and it's falling. At the top here we have Pfizer and Eli Lilly, and in a second we pretty much have Bristol Myers and Johnson & Johnson sharing that spot. Price earnings are market value measures. We have Bristol Myers way up there. The rest of these guys grouped together. I don't know if you can see it, but we have Johnson & Johnson in second, followed by Merck, Pfizer, and at the bottom Eli Lilly. So once again, Bristol Myers taking that one. And then once again, market to book, Bristol Myers way up top, followed by Johnson & Johnson, which is inclining. Eli, which is in third, but it's falling. And these two guys at the bottom, Pfizer and Merck, are climbing but low. And the EVA here, Johnson & Johnson at a large margin. You can see how much Pfizer here, it's been a little volatile. And the rest of these guys all grouped together with Bristol Myers laying there at the bottom. This is the EVA and chart like I showed you last time. Pfizer over here at 5,300. Remember that was the same level that we had Exxon in the last bit. Johnson & Johnson over here at 14,746. Pretty easy win for that, guys. Recap. Leverage, we had Johnson & Johnson taking that. Remember, they had less debt and a greater ability to pay. Asset efficiency, we had Eli and we had Johnson & Johnson not too far behind. Profitability, Eli and Pfizer were ahead in every category. Johnson & Johnson was third every category. Bristol Myers dominated the market value measures and economic value added. Johnson & Johnson took that one. So my selection is Johnson & Johnson, and it's because in uncertain times, guys, they have the capacity for debt. They don't have a bad asset turnover. It wasn't at the top, but it wasn't a bad. Profitability wasn't high, but it was not bad. A lot of these measures were climbing. Market value measures, they were second in climbing, and they dominated the EVA, so they're going to be my pick from the pharmaceutical sector. Alright guys, now to do our final comparison between Exxon and Johnson & Johnson. The first thing we have up here is the equity multiplier, the debt constraints, and we can see that Exxon has got a higher amount of debt. They're both falling, but Johnson & Johnson's a good bit below it there. Once again, although Exxon does have higher debt, it does have a greater capacity to pay. You can see Johnson & Johnson just looking flatline compared to it. We're looking at 39.3, 4,477. Alright, asset efficiency. We have Exxon there at the top, doing better with that, and Johnson & Johnson here below. Not terrible difference, but Exxon clearly taking that one. Profitability, now that's important, and we have Johnson & Johnson here at the top and headed up, and we have Exxon down here at the bottom and headed down. Return on asset, once again, they're about the same, but what's important is that we have Johnson & Johnson headed up and Exxon headed down. Return on equity about the same, but again, Johnson & Johnson headed up, or at least flattened out, and Exxon in descent here. Price to earnings ratio about the same, both about stagnant. Exxon a little bit below Johnson & Johnson, nothing I think to be too concerned about. But market to book, we have Johnson & Johnson just up and headed, and Exxon down here, so investors clearly valuing Johnson & Johnson as a better candidate. Economic value added, we have Johnson & Johnson pretty superbly above it. Remember, Exxon's at 5,160, Johnson & Johnson is at 14,000, and Exxon's headed up a little bit, but you know, planning out there, they're literally so far behind that's not going to make a difference. So my final pick, Exxon had a higher debt but had better capacity to pay. Exxon has higher asset turnover. Johnson & Johnson profit margin was greater. Both Exxon and Johnson & Johnson's ROA and RE were about the same, but Johnson & Johnson's climbing and Exxon was falling. Johnson & Johnson higher price to earnings as well as market to book, and both climbing. Johnson & Johnson had a much higher EVA. So my final pick is Johnson & Johnson. Thanks guys.